Breaking news that could put an extra $20,800 back in your pocket this year, and I'm about to tell you exactly who qualifies and how to claim it. In the next few minutes, you'll discover the complete breakdown of the new expanded child tax credit that's part of a recently passed bill. I'll walk you through the exact qualification requirements, show you how the refund system works, and explain why this could be the biggest financial boost your family sees this year. Plus, I'll compare it to the old system so you can see just how much more you could be getting. Welcome to Financial Area, where we break down the latest financial news that directly impacts your wallet. If this information helps you, make sure to hit that like button and subscribe for more money-saving updates that you won't want to miss. Now, let's dive into what could be life-changing news for millions of American families. A new provision has been passed that dramatically expands the child tax credit, and the numbers are absolutely incredible. We're talking about an average refund of $2,800 per family, but some families could see even more than that, depending on how many children they have. This isn't just a small tweak to the existing system. This is a complete overhaul that puts significantly more money back in the pockets of working families. The old child tax credit system left many families with much smaller refunds, but this new provision changes everything. What makes this even better is that these changes are permanent. There's no sunset provision, which means Congress would have to actively vote to remove these benefits in the future. The timing couldn't be better either. With inflation hitting families hard over the past few years, this expanded credit provides real relief right when people need it most. And unlike some previous expansions that were temporary, you can count on these benefits if it's being available year after year. So what exactly are the numbers we're looking at? The maximum credit has been increased to $2,200 per eligible child. That's a substantial increase from previous versions, and it gets even better because this amount will automatically adjust for inflation going forward. This means as the cost of living rises, your child tax credit will rise with it, maintaining its purchasing power over time. But here's where it gets really interesting, and where that $2,800 average comes from. This credit is split into two parts, and understanding this split is crucial to maximizing your benefit. The first part is $1,400 per child that's completely refundable. The second part is $800 per child that's non-refundable. If you have 2 children, you're looking at potentially $4,400 in total credits, which easily explains how that $2,800 average is actually conservative for many families. For families with 3 children, we're talking about $6,600 in potential credits. 4 children? That's $8,800. You can see how quickly these numbers add up, and why this represents such a massive benefit for larger families who often face the highest expenses. The implementation timeline is straightforward but important to understand. These changes take effect for tax year 2025, which means you'll see these benefits when you file your taxes in 2026. There are no retroactive benefits for 2024, so this is something to plan for in your future financial planning. Now, let's talk about something that confuses many people but is absolutely critical to understand: the difference between refundable and non-refundable tax credits. This distinction determines how much actual cash you could receive from the IRS. The refundable portion, that's $1,400 per child, is pure gold for families. Refundable means you can receive this money as cash back from the IRS, even if you don't owe any federal income taxes. Let me give you a real example to illustrate this. Say you're a single parent with 1 child, and after all your deductions, you owe $500 in federal taxes. That $1,400 refundable credit doesn't just eliminate your $500 tax bill. You'll actually receive $900 back as a refund check from the IRS. This is incredibly powerful for lower and middle income families who might not have large federal tax bills but could really use that cash injection. It's essentially the government sending you money, not just reducing what you owe. The non-refundable portion works differently but is still valuable. That $800 per child can only be used to offset taxes you actually owe. Using the same example, if you owed $1,000 in taxes, that $800 credit would reduce your bill to $200. But if you only owed $300 in taxes, you'd only get $300 worth of benefit from that non-refundable portion. The remaining $500 doesn't come back to you as cash. Here's where it gets really interesting for different family situations. Let's say you're a married couple with 2 children and you owe $2,000 in federal taxes after all deductions. You'd get $2,800 in refundable credits. That's $1,400 times 2 children. This completely wipes out your $2,000 tax bill and puts an extra $800 in your pocket as a refund. On top of that, you'd get $1,600 in non-refundable credits. That's $800 times 2 children. which would further reduce your tax liability if you had owed more. For families with very low tax liability or no tax liability at all, this system is particularly beneficial because that refundable portion comes to you regardless. This makes the child tax credit function almost like a guaranteed income supplement for families with children. The beauty of this system is that it works for families across different income levels. Whether you're a family that typically owes taxes or one that usually gets refunds, this expanded credit puts more money back in your hands. Now let's talk about who actually qualifies for these credits and the income limits that determine how much you can receive. The basic eligibility requirements haven't changed dramatically from the previous system, but it's worth reviewing them. Your child must be under 17 years old at the end of the tax year to qualify. They must be your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of these individuals. The child must live with you for more than half the tax year, and you must provide more than half of their financial support. The child also needs to be a U.S. citizen, U.S. national, or U.S. resident alien, and they must have a valid Social Security number issued before the due date of your tax return. But here's where income limits become crucial. The credit begins to phase out for single filers with adjusted gross incomes above $200,000 and says, for married couples filing jointly with incomes above $400,000. This phase out is gradual, so you don't lose the entire credit immediately once you cross these thresholds. For single parents, once your income exceeds $200,000, the credit reduces by $50 for every $1,000 of income above that threshold. For married couples, the same $50 reduction applies for every $1,000 above $400,000. This means higher income families can still receive partial benefits, but the full credit is reserved for middle and lower income families. These income thresholds are actually quite generous when you consider that they allow families earning well into six figures to still qualify for substantial credits. A married couple earning $350,000 would still receive the full credit, which represents significant tax relief, even for higher earning families. Let's put this in perspective by comparing it to the old system. Under previous versions of the child tax credit, families received significantly less money, and the refundable portion was much smaller. Some families received no refundable benefits at all. The old system also had more restrictive income requirements and didn't include automatic inflation adjustments. A typical family with 2 children might have received $2,000 to $3,000 total under the old system. Now, that same family could receive up to $4,400, representing an increase of $1,400 to $2,400 per year. For a family with 3 children, we're talking about going from roughly $3,000 to $4,500 under the old system to potentially $6,600 under the new system. That's an increase of $2,100 to $3,600 annually. These aren't small changes. We're talking about money that can cover several months of groceries, help with childcare costs, or provide a substantial emergency fund for families. For many families, this represents the largest tax benefit increase they've ever experienced. However, there is one aspect that could be improved. Rather than receiving this money as a lump sum when you file your taxes, it would be more beneficial for families to receive monthly payments throughout the year. Monthly payments would help with cash flow and allow families to better budget for ongoing expenses like childcare, food, and housing. Some previous versions of expanded child tax credits included monthly payment options, and hopefully, future adjustments to this program will include that feature. Nevertheless, even as an annual lump sum, this represents substantial financial relief. To maximize your benefit from this expanded child tax credit, there are several steps you should take. First, ensure all your children have valid Social Security numbers well before tax season. Delays in obtaining Social Security numbers can delay your refund. Second, keep excellent records of your children's living arrangements, especially if you're divorced or separated. You'll need to prove your children lived with you for more than half the year. Third, consider the timing of your income if you're close to the phase-out thresholds. Sometimes shifting income between tax years or maximizing retirement contributions can keep you below the phase-out ranges. Finally, file your taxes as early as possible to receive your refund quickly. With refunds potentially reaching several $1,000s, getting that money sooner rather than later can make a real difference for your family's financial situation. This expanded child tax credit represents one of the most significant improvements to family financial support in recent years. With permanent status and automatic inflation adjustments, it provides long-term financial stability that families can count on. If you found this breakdown helpful, make sure to like this video and subscribe to Financial Area for more updates on tax changes, financial benefits, and money-saving strategies that directly impact your bottom line. There's always more financial news that could put money back in your pocket, and we're here to make sure you don't miss any of it.